lesson. Very simple, very easy, but very valuable. And what I really want to break down today, guys, is something that we kind of talked about yesterday. All right. With, I guess it incorporates a little bit to mirror trading as well. Why mirror trading doesn't work? Because again, I could take 10 trades with a 50% win rate, right? I can take 10 trades with a 50% win rate. That means I will have 5 winning trades. That means I will have 5 losing trades. Well, again, as long as you can manage your risk appropriately, let's assume that you're stopping out on these 5 trades at $50 a piece. Let's just say that's your plan. You're looking to make $100 a trade, right? That's your 2-to-1 risk reward, and you're looking to not stop out more than $50. All right, so you're implementing a 2-to-1 risk reward approach. You're trading A+ setups, and let's just say that day you took 10 trades and you had a 50% win rate. That means you won on 5, you lost on 5. This is the beauty about managing your risk. Even with a 50% win rate, you would think that's bad. How am I going to be profitable? Well, you have to implement that 2-to-1. Right? So again, let's assume you have a plan, you have a strategy, you have an edge, and you've determined your A+ setups, right? To where all of the A+ setups you take do have a 2-to-1 risk reward. All right? And let's just say that day you come into the market and it was a pretty choppy day. You take 10 trades with the 50% win rate, right? It means you win 5, you lose 5. Still, at the end of the day, right, you're still going to be profitable. So on trade 1, you make 100. On trade 2, you lose 50. So you're up $50. Times 5, right? Because again, you're taking 10 trades. You would profit $250. Give or take, assuming, everyone was exactly a 2-to-1. You took exactly 10 trades with exactly a 50% win rate, and assuming each and every one was a $100 winner or a $50 loser. You could still make money in the stock market with a 50% win rate as long as you incorporate a 2-to-1. So what's a 2-to-1? All right, what's a 2-to-1 risk reward? That means if you're looking at a chart, right? You're looking at a chart and you want to buy it here and your stop loss is there. Let's say that stop is 0.10. A 2-to-1 setup would mean if you're looking to buy off a retest of the prior breakout, your stop is going to be 10 cents. That means you have to go ahead and see and ask yourself, do I have potential to make at least 20 cents? Do I have potential to make 20 cents of profit? If I know my risk, if I make this entry here, I know my risk is 10 cents. Does the chart provide potential for me to make 20? If the answer is yes, fantastic. That is a 2-to-1 setup. Now, if you see potential for the chart to make you 0.30 cents, and it looks pretty easy, that would be a 3-to-1 setup, right? Because you're looking to make 3 times as much profit than your anticipated loss of 10 cents, all right? So let's go ahead and clear some of that out. That is a 2-to-1. A 3-to-1, again, is even better, right? You have opportunity to make 3 times your loss. A 5-to-1, you have the potential to make 5 times your loss. The higher the risk reward, the better. But for this example, we're going to go ahead and assume that you're banging out 2-to-1 setups, right? For every 10 cents of risk, you're making 20 cents of profit. You have 10 trades with 50% win rate for the day, only trading these A+ setups, you can still be profitable. So where am I going with this? Trading is a numbers game. That's really what trading is. It's a numbers game, guys, right? So here's where I want to really hit this on the head. If you identify 10 A+ setups, all right? They're A+ setups, right? You've identified them. They have 80-20 odds, but you sit here and you pick and choose which ones you want to trade. I'm going to take number 2, number 5, number 7, number 8, right? But they're all A+ setups. They all have great risk reward, 2-to-1 or higher. They're all 80-20 setups, right? They're A+ setups. You've back tested them and they work. But let's say you identify all 10 at any given moment and you just pick and choose the ones that you want to trade. Again, you pick and choose number 1, number 2, number 5, number 7, number 8. You could have chosen the loser, the the loser, and you could have chosen one winner, right? Just to watch trade number 3, number 4, number 6, and number 9 work out. Now you're frustrated, right? When you say you're frustrated, you've identified 10 A-plus setups. Again, this is all hypothetical. This is an example. I'm not saying you're going to find 10 A-plus setups in a given day, all right? But for the purpose of round numbers and math to make it easy, let's assume you did. And let's assume you have 10 A-plus setups sitting right in front of you. If you just pick and choose which ones you want, you could pick all green. You could pick all winners, right? You could pick the 4 trades that are just absolutely awesome and amazing, right? But you could also pick the 4 losers. Imagine picking the 4 losers and seeing those 4 winners run. Wouldn't you be a little discouraged? Wouldn't you be a little upset? Like, man, I picked the wrong trades. Now you're emotional. Now you're out here finding other trades. Now you're hunting for trades, and now you're forcing trades. So again, trading is a numbers game. If you want consistent results, and hypothetically you find 10 A-plus setups, you should take all 10 A-plus setups. And an A-plus setup, in my opinion, in my eyes, is a setup that you've back tested, that you've seen consistent results with, that have at least 70, 30, 80, 20 odds. You have a higher probability of one thing happening over another. And the only reason you know you have a high probability of one thing happening over another is because you've back tested that setup time and time again, and you found 70 to 80% win rate with those setups. So you can't pick and choose. You can't be picky on an A-plus setup. Now, again, you can be picky when analyzing, and that's where I want to draw that fine line and where it can be confusing. We want to be picky with our setups. We don't just want to trade random setups and just terrible odd setups. It's okay to be picky when identifying the type of setup. But once you've identified it's an A-plus setup, don't be picky on trading it, because then you're going to pick and choose, and you could pick all the losers, right? And maybe you don't take the other 5 trades and those were the winners, and you could have made $250, even with the 50% win rate. Does that make sense, guys? Be picky with your setups. But if it's identified as an A-plus setup, and you know it's an A-plus setup because you've back tested it time and time again, don't sit here and have 2 options and be like, which A-plus setup do I want to go with? Because you may take the losing A-plus setup and realize that even if you would have taken this setup in conjunction with this one, you still would have been profitable. So take both. Don't be picky when they're A-plus setups. If they're A-plus setups and you like them, take both. Because you have odds of one going in your favor based on those probabilities. Even if the other one goes against you, based on a 2-to-1 setup, guys, you can still be profitable. So again, trading is a numbers game, right? It's a game of numbers. For every 10 trades you take, right, you will win on 60 to 70% of those. Over time, you will go from a 50% win rate. You will start seeing a 60% win rate. You will start seeing a 70% win rate, all right? You will slowly increase your win rate. You will slowly increase your odds, right? But you can't pick and choose which ones that you want to trade. Again, 2 beautiful A-plus setups. You need to take both of them, right? They both may go against you. They both may go with you. But if one goes against you and one goes with you, and you execute the trades beautifully and you implement proper risk management skills, you can cut that small loss and you can bank your nice winner and still be green even with a 50% win rate. So trading is a game of numbers. If I see an A-plus setup, I'm going to take it. If I see another A-plus setup, I'm going to take it. If I see another A-plus setup, I'm going to take it. That's why some days you see me taking 10 trades, because I see 10 setups that I like. And I know that over the course of 10 trades, I could lose on half and I can win on half and I can still be profitable. How many times have you seen me having 10 tickers traded on the day? 10 different trades. And everybody's like, damn, that's a lot. They were all A-plus setups and I was still profitable on the day. Now, there are some days to where I'm not profitable, but those days were very minimal. All right. So again, trading is just a game of numbers, especially when looking at A-plus setups that you've identified as being A-plus setups by back testing. Again, we cannot pick and choose. And that's why mirror trading does not work. Because again, if I take 10 trades, right, I could actually be profitable at the end of the day. But let's say that you take 5 of my 10 trades and you lose money. Now you think that, oh, Josh sucks. He's setting me up for failure. How's he making money and I'm not? Well, there's a lot of variables. I have a larger account maybe. I can take 10 trades. What if you have a cash account and you can't take 10 trades? What if, I have a 10,000 share position on one trade, I make a lot of money, but my other trades that were losers were smaller positions, right? So there's a size variable. There's the amount of trades that I can take is a variable, right? There's a lot of variables on why mirror trading doesn't work, all right? That's why, again, it doesn't work. And again, that's why trading needs to be looked at as a numbers game. We have to be picky on our A+ setups. We have to be picky identifying the A+ setups. But once we've identified that it's an A+ setup, because it's been back tested, we have proven consistent results with it, we have to be able to execute those trades without hesitation. Because if we sit there and we're picky and we pick and choose, right, we could put ourselves in a position of only choosing the losing trades and missing out on the winning trades. But if you would just take all of them, now you have better odds, right? You have 70-30, 80-20 odds. So you could see 7 to 8 of those green and 2 red, and now you're like, I'm happy I took all of those trades, right? You're diversified. Think of it as long-term investing, right? You have 10 stocks you want to invest in, okay? And all for great reasons, right? The fundamentals, what they have going in the future. You've identified 10 stocks that you want to invest in for 20 years, right? You're not going to put all of your eggs in one basket and hope that's the one that goes. You're going to diversify, right? You're going to put $1,000 here, 1,000 there, 1,000 there. You're going to spread your money out equally across those 10 long-term investments because not all of them are going to go up. You want to diversify. You want to separate. You want to not put all your eggs in one basket. Same concept with day trading, right? You don't want to have 10 A+ setups and just pick one and hope it's the big winner. Diversify. Take 10 of those setups, and if 3 go against you, that's okay. Cut your losses and let the other 7 make you profits. Okay? Does that make sense? We can compare it to long-term investing. It's the same thing, but in a different format for day trading. Okay? But it's the same concept of not being picky. If you find 10 companies you want to invest in, you're going to diversify. If you find 10 A+ setups, you're going to want to take those 10 A+ setups so you can be right on a majority, cut your losses on the ones that aren't working, and see those consistent results. Not picking and choosing one stock that you want to go all in with and hope that's the next big mover. What if you're wrong? You're going to be mad that you didn't diversify and take those setups you identified as great setups. All right, so how do we do that? How do we identify an A+ setup? Well, number one, it's understanding setups. It's understanding technical analysis, right? That's really all it boils down to. Is how do we identify what an A+ setup is? Well, again, first we have to know what a bull flag is. We have to know what a bear flag is. We have to know what an ascending triangle breakout is and a descending triangle breakout. We have to understand what a head and shoulders is and what an inverse head and shoulders is, right? We have to understand the technicals. We have to understand the patterns and the criteria behind them. Bull flag, increased volume along the leg up, followed by a decreased period of consolidation with a break on increased volume to the upside, right? Inverse head and shoulders. We want to wait for the confirmation break of the neckline to get the leg up. So every pattern, every setup will have its own unique approach, its own unique layout of criteria that needs to be met. And that's why we really dive into the criteria on setups live and in lessons. So you guys know setups, right? You guys know the criteria, you know the setup. So now what you need to do next, you identified good A+ setups. And again, an A+ setup is a setup that has high odds of one thing happening over another. 80% chance of the stock working out in my favor, 20% chance of the stock going against me, right? And again, that could be a pattern. That can be a reversal, a candlestick pattern, right? It could be a lot of different things, right? Big dump into support, looking for those quick bounces off those hiccup areas, right? So again, it could be all kinds of things, but it's something that's been identified that you have higher success with and less failure, okay? So how do we go through and identify, setups that work for us and really get familiar with these A+ setups? So when you see one, you know it, you know how to trade it. You got to paper trade it, guys. You got to paper trade it. I recommend everybody getting a blank notepad. Getting a blank notepad, $1 at Walmart. Go get a notepad, all right? Start with page 1 and write down bull flags. Write down bull flags. And what you're going to do is for 1 week in a paper trading account, you're going to trade bull flags. That's all you're going to do for 1 full week. You're going to trade bull flags. Now, again, if you're like, man, I only traded 2 bull flags, there wasn't a lot. That's okay. Go to week number 2. All right, week number 2. We're going to trade, the pullback, the breakout over resistance, the pullback. Again, logging your trades, looking for that criteria to be met. All right. And let's say you're 4 weeks into it and you realize you didn't really backtest a lot of bull flags because you weren't seeing a lot of them, but now you are. So now you can go back to week 1 and you retest some of those bull flags until you have 10 to 20 different trades. Again, you want to take a bull flag and you want to test it for a week, all right? And then go to week 2, test the reversal. Week 3, test head and shoulders patterns. Week 4, test inverse head and shoulders. Anytime you see market conditions giving you one set pattern and one set flow of, again, sometimes in markets, we see just nothing but bull flag, bull flag, bull flag, bull flag, right? Some weeks we see nothing but red to green moves. And that's all we see is a lot of red to green, red to green, red to green moves. So again, the biggest thing here is getting that piece of paper and writing down bull flags and taking a week and trying to log as many bull flag trades as possible. Again, the ticker, right? The date, the time, so you can go back and look at the chart at that point in time when you go back and review the data, right? So again, the ticker, the date, May 20th, 11:48, and you're logging this after the trade took place. I saw a bull flag. We had a strong move to the upside. There was increased volume. Check mark, right? Because that's a piece of criteria. There was increased volume. There was a period of consolidation with decreased volume, and it formed a nice flag pattern. I made my entries at 680, and my stop loss was below the consolidation at 660 with a target of the flag high, 720, all right? This was a losing trade. What was my emotional state? How was I feeling that day? Was I foggy? Was I cloudy? Was I hyped up? Did I have the feeling of FOMO? Log that, right? Log everything that you can log. And once you have 10 to 20 trades, right, you can go back and you can review all these trades. Okay, May 20th, 11:48, bull flag, entry at 680. Go look at the chart. All right. And where did I go wrong, right? Where did I go right? What can I compare? Can I compare this trade to another trade that I've taken that was successful? So you're going to be able to sit there and compare all of your losing trades for the bull flag against all of the winning trades for the bull flag, and you're going to start noticing things that stand out to you. Oh, this winning trade, I saw this happen. This winning trade, I saw that happen. This winning trade, I saw this happen. Compare the winning to the losers. This losing trade didn't have that happen. This losing trade didn't have that happen. Wow, this is starting to make a lot of sense. I'm starting to see why I was winning on these particular trades and why I was losing. You're going to be able to compare those 20 trades side by side, and you're going to start seeing the differences between the two. And that's when you're going to be able to really just consolidate everything together, and that's how you're going to have an edge. That's how you determine an edge. But you can't determine an edge unless you backtest. You can't determine an edge unless you have data to compare against. You can't. The more data, the better. If you only have 2 bull flags to compare against, it's not enough. You need to have 20 plus different trades logged that you can go back and review the data and compare it against one another. Because that's when things start making sense. That's when things start standing out. You see why the setups worked with you, and you see why the setups worked against you. And you're going to start being able to pull little things out of both and reapplying that to your bull flag strategy. And once you've pulled all those little things out, and you've built it into your approach for bull flags, you're going to backtest it again. You're like, what? I thought I was done. You're going to backtest it again, right? You're going to take all those little things you pulled from the winners and the losers out of those hypothetical 20 trades, right? And you're going to build it into your bull flag edge, your edge for flags. Everybody has a different edge for flags as far as entries, exits, everything, right? The criteria is the same, but as far as how traders make trades and execute are all different. And it's because they're pulling these things out of their round 1 of failures and successes and identifying what they see, what would work for them. And now they're going to backtest that over 20 trades. And let's say you have 80% win rate. Great. You have identified an edge when it comes to bull flags. Let's say you have a 20% win rate. You got to go back to the drawing board. Go back to those first 20 trades and pull some new things out of it that you're now seeing and build that in to your bull flag edge. And then test that again, 10 to 20 trades until you have a high consistent win rate. And once you have consistent win rate after identifying what works and what doesn't work, and now you understand what a bull flag is, you know what they look like, you know their criteria, you know where you want to make entries, where you want to put stops, where you want to take profit, and you know those levels because you've back tested 20 times and you have 70, 80% win rate. That's when you can dive in with a real account and start trading those real time because you've already eliminated the flag setups that don't work. You've reviewed the flag setups that do work. You've taken all that data and compiled it into your edge for bull flags. And now you have consistent results with bull flags. So anytime you see one, you know which ones you want to trade, which ones you don't want to trade based on all of those reasonings that you've identified based on the gathering of that data. It's very, very important to, again, journal your trades, log your trades in the very beginning so you can see what's working, what's not working, and why it's not working and why it is working. 2 to 3 trades is not enough. 20 trades is just the bare minimum. If you can have 100 trades logged and you can review every single trade and pull something from each and every one and compile that data, you're going to be successful because you're going to realize what's working and what's not working and why in the first place. So a lot of traders don't like to paper trade. That's why the statistic is 95% of traders fail because they don't want to take the time to compile that data to really do what every successful trader's done. Do you think Wall Street traders, hedge fund traders, professional traders just dove on in and they were great? No. Matt paper traded for a year. I've seen this guy's spreadsheets on Excel. Ridiculous. So much data, so many tickers, so many trades. If you like Excel spreadsheets, build this into an Excel spreadsheet. If you like writing things down like I do, write it down in a notebook. But logging and journaling your trades is important, and paper trading to where you're not risking real money in the process while you learn your edge. And you can come to find out over those 100 bull flag trades, man, I didn't win on a single one. I suck at bull flags. Well, guess what? Move on. All right, bull flags right now I'm not having good success with. Whatever the reason is, I'm not finding great success. I will come back to the drawing board later on with bull flags. Let's go ahead and focus on ascending triangles. Do the same thing. You're going to do that for bull flags, bear flags, ascending triangles, descending triangles, head and shoulders, inverse head and shoulders, the 5-minute reversal strategy, the 90 MA pullback, the, as Wes would say, FTB pullbacks, right? You're going to do that for everything that you learn, every strategy that we teach, everything that you are soaking up. You're going to want to back test that. You're going to want to get as much data as possible so you can compare it against one another, pull those little things out, and then recompile it into your own approach. Again, your own approach. That's your edge for trading these particular setups. That's where you're going to actually start building a playbook of things that work for you, right? A playbook of 5 setups that you have great success with. And when you see a setup, you know exactly how to execute. You know exactly how to cut your loss. You know how to exactly take profit. And that's how you're going to be a successful stock trader. I was not going to be a successful stock trader my first 2 years because I did not do this. I then did it for a freaking year and it sucked. I'm going to be honest. It wasn't fun. Paper trading. No one likes paper trading, right? But great things in life don't come easy, right? You have to be willing to make small sacrifices, paper trade, to get to the next level so you don't blow up an account and just give up because you're discouraged. So what did I do? I finally took a step back, realized I am taking the wrong approach. I need to paper trade and I need to log. I will go open up my closet right now and I will pull out freaking millions of pieces of paper that I have stored still from me logging all my trades. How did I get good? Because I paper traded for a year. Everything that I'm telling you to do right now, right? The data, the compiling, the paper trading, one pattern at a time, right? 50 trades, going back and comparing them at 12 o'clock at night, right? Reviewing them, writing down similarities, and recompiling it and reapproaching that same, setup with what you've written down. Guys, it's ridiculous. A lot of paper. I've done it. But it's what's going to get you to the next level. It's what's going to make you a great trader. Managing the risk, executing without hesitation, right? Understanding the flags to trade and the flags not to trade based on what you see, based on experience. Okay? So guys, that's what I want to talk about today. Trading's a numbers game. All right? When you identify A+ setups, you can't be picky. You need to trade your A+ setups, because if you're picky on which ones you trade, you could unfortunately pick the ones that are losers. Diversify. Just like you diversify for long-term investing, right? On those 10 A+ long-term investments you want to trade, you're not just buying Apple. You're buying Apple, Facebook, Netflix, SPY, Snap. You're buying all of these because you believe they're all A+ setups, but they're not all going to work. We know that. It's very rare that you're going to have 100% of your stocks doing what you want. But having high probabilities of one thing happening over another, you should see 7 or 8 of those move and 2 or 3 go against you. But you're still a winner because you have diversified long term. Take that same diversification mindset, right, and apply it to, I know what an A+ setup is. I've paper traded. I've identified my A+ setup. So anytime I see one, I'm going to take the trade, because trading is a numbers game. For every 10 trades I take, I will win on 6 or 7. All right, if I take all 10 of them, I will win on 6 or 7. I will manage my risk appropriately on the losers, and I will make good money on the winners. And again, how do we identify what an A+ setup is? How are you going to identify your A+ setup? You're going to have to actually paper trade and back test these setups. You're going to have to log your data. You're going to have to journal your trades. You're going to have to go back and review them and compare them against one another. Is it time consuming? Yes. But here's the last thing I want to leave you guys with. You can sit here and not do this, and next year maybe be in the same place. I'm still breaking even on trades. I'm still not profitable. I still have yet to identify my edge. And you're already a year into it. Or you can start now. Next year, identify your edge. Back test everything. Solidified your approach. And now you're ready to rock and roll with real money. Right? Spend a year now, disciplined, and do the right thing. Or spend a year, don't do the right thing. Go ahead and just do what you want, like I did in the beginning. I'm going to do what I want. I'm going to do what I want. I know I'm going to do what I want, right? And then, only become successful 4 years into it. If I would have done that my first year, guys, my second year would have been profitable. My third year would have been profitable, right? I was profitable in my 4th year, right? I could have been profitable in my 2nd year. Now that I look back in hindsight, I wish I just would have disciplined myself and said, you know what? I'm going to do what I should do. I'm going to paper trade and log. Because I could have been profitable year 2, 3, 4, 5, 6. I would have 3 more years under my belt, 2 more years under my belt of profitability. I could have very much excelled my trading career much faster and not have lost $50,000 in the process. So take it from experience. These are all things that I wish I would have done as a trader. And these are all things that I ended up doing as a trader. The only thing that I wish I would have done differently is incorporate this and implement this in the beginning, right off the bat. To where when I was done within a year, I'm now making money. The last thing you want to do is not make money this year and then start doing this and it take a year. Now you're making money your 3rd year. Wouldn't that suck? You could be making money by year 2. Again, this is all hypothetical. It depends on how much you put into it. I've seen traders do this in 3 to 6 months, right? It doesn't have to take you a year. I've seen traders do it in 3 years. It depends on the initiative you take, how motivated you are, and how serious you are. You don't have to start making money 3, 4 years in. You can actually start making money in 6 months to a year consistently by doing what we just now talked about. Again, identifying the A+ setups, understanding setups in the first place, back testing them, journaling them, logging them, reviewing them, finding the similarities, pulling all of this data out. Here is my edge on this pattern, on this setup. These are my setups. This is my edge. I have consistent results because I've back tested them for a long time. But now I am confident. I'm no longer scared to trade stocks, right? I no longer have emotions when it comes to stock trading. I am logical. I am smart. I am disciplined, calm, cool, collective. I trade without fear. I trade without emotion. I trade without hesitation. That is when you're going to be able to come into the market and do what professional stock traders do. Make consistent money. That's it, guys. That's all I got for you. That is the most important thing you guys should be doing, all right? Again, I lose money in the market. Do you guys see me getting mad and discouraged and punching my computer? No, I don't care. I'm emotionless because I know at the end of the year I'm going to be profitable. The only reason I know at the end of the year I'm going to be profitable is because I did everything I'm telling you guys to do. And I've found consistent results, right? I don't look at trading as every day, every week, every month. I look at trading as a year. That's why my bills are paid up for a year, right? I can live right now for the next 12 months and not do a damn thing, right? That allows me to come into the market and have losing days, losing weeks, losing months, because I know over the course of a year, I'm going to make money, right? And I'm going to be able to pay myself ahead again for a year, take the rest and reinvest it, take the rest and buy myself something that I want to buy, whatever. Spoil myself, treat myself for my hard work and dedication and discipline, all right? So again, make sure you guys are doing that. I want to see you guys successful. I want to see you guys succeed. I've done it. Chris has done it. Beth has done it. Matt has done it. I mean, Matt went overboard, but again, it pays because now he's been trading options for 10 years and he's making consistent 6 figures. So take it from the individuals that are actually making consistent profit. We all share the same thing. We've all paper traded. Just because it was options or futures or penny stocks or whatever. We've all done the same thing. We've all paper traded. We've all logged the data. Everything that I just talked to you guys about over the last 30 minutes, we've all done it. Every successful trader's done it. So again, piggyback off the successful traders. Do what the successful traders have done in the beginning. Follow in their footsteps and you will be successful as well. If you take more initiative and you apply yourself a lot harder, then you will see results a lot faster. I saw results in 3 years. I could have saw results in a year. So don't do what I did and wait 3 years before you actually get your shit in check and do what the right thing is. Go ahead and get your shit in check today and do what you know is right so you can see results tomorrow, not next year, not in 2 years. All right, guys? So again, quick little rant, more of a rant than a lesson, but very important on how to actually get into a paper account in the first place and what you need to do while you're inside of that paper account.